Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, Bob's been hard at work in the lab and he thinks he's figured out what the Fed is up to. And it's going to be important that you listen to this. So let's dive in.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Bob, Maestro, what have you cooked up for us this time?
Yeah, Phil. I mean, one thing that I've been watching here is why is the Fed so insistent upon keeping the interest rates high, but at the same time, they're letting the fiscal run wild. And the only thing I can think of is that there was a time in the 1940s where we were in the same kind of situation with a high debt to GDP, and we had, let's call it an event, right? You had the Great Depression and you had World War II, and now we have what's going on with the pandemic. A lot of liquidity came in with the pandemic. And then, like the Great Depression, a lot of liquidity came in. And then we had World War II. And how did they deal with this? And so what I'm seeing here is that we're going to get a bit of financial repression, but they're going to give us higher interest rates. They're going to actually suppress them at this level here. Okay. They're not going to lower them. They're not going to let them go any higher. And basically to keep the froth out of the speculation in the market. Okay. But at the same time, they need to make sure the banks have a positive yield. And at the same time, they need people spending money to generate tax revenue. And so what we're seeing here, what I've been waiting for, and I've been talking about this in the room for a long time, is that they need to get velocity of money to move. And it doesn't matter if the supply of money's falling, credit creation's falling. If velocity can operate at a higher level than the fall of supply, they're going to be able to get the transaction revenue that they need to be able to drive income taxes. So the first chart I want to show you here is that it's actually happening, is that dip that you see down there was, the dip into the pandemic, also into the, whatever they were doing after the surge they did for 2009. But we're finally getting a crossover and we're getting some bullish divergence in the M2 velocity of money. Well, all velocity of money is, Phil, is how fast it leaves your wallet and goes into somebody else's wallet. And it keeps us driving and churning. And from that's where governments, basically governments are a gambling operation, right? They just want the transaction so they could take their VIG, as they call it, right? They just want their tax, their piece of the action. And so they need velocity to do that. So you need a little bit of inflation, and you need a little bit of wage inflation. And at the same time, is like in World War II, they made us clip coupons. Remember that? Well, you don't remember that. I don't remember that, but our grandparents remember that, where you couldn't drive your car, you couldn't buy meat, you couldn't do this, you couldn't do that. And they're going to do it with interest rate policy, I think, and they're going to do it through bank lending. But at the same time, the government's going to be out there greasing the economy with spending, and they're going to try to keep velocity. Remember, poor people spend more money than rich people of their percentage of income. And so they don't really want savers. They want spending to drive economic activity. So that's my view on this. I'd love to hear people's views, whether I'm right or not. But I want to also pivot, Phil, because the week's going as we suspect it.
Right.
And yesterday we had the Japanese meeting, and I think they digested it pretty well. So really all things are fed tomorrow. And before I show this next chart, I'm going to throw it back to you. If you can maybe give me your thoughts, maybe how you see the rest of the week playing out. And then I'm going to give you my thoughts on the way people are positioned, how I think November, at least into Thanksgiving, will play out.
Okay, so we're going to go live on the FOMC meeting tomorrow at 2 p.m. Eastern. So head over to the YouTube channel and we'll have our live broadcast there. But what I'm looking for tomorrow is typical reaction, right? We're going to get a range from the announcement. We're also going to have the presser at 2:30, so the move, plays out through that. How we react to that initial range, I think, is going to tell us what the move's going to be, I think, longer term. So if the algos typically freak out and you get a high and a low, and then as we move either up through the high or down through the low, I think is going to be the tell on what we do. Now, keep in mind, we came down to oversold levels. We do have a bounce here that can certainly turn into a dead cat bounce, meaning that you start to roll over and go back down to test the lows. Now, whether we do that from the levels we saw today or maybe tomorrow on a spike high off the announcement and then roll back over. So if we start cracking down through the lows of the announcement reaction, I think you have to start looking at the lows of last week to be tested. Now, that can still mean that they hold and then we can move back up. I do think we have some of those gamma tailwinds start picking back up after, I believe it's the 3rd of November. Remember, we're in this 4-day turn window too, where statistically we should end higher than Friday's low by the 2nd. So that's a very strong statistic. So that Friday low should hold through Tuesday, despite the Fed announcement and things like that. That's what we should expect. So I think it really depends. Tomorrow afternoon going into, which we say Thursday, that's going to give us a big tell, I think, on what we can expect for the direction to hold going into, I think, next week. The other thing I might point out too is on Thursday, we're going to get the composition of the debt that Yellen is going to be doling out. So we know she's going to, I think, build the TGA up to about a $750 billion mark into December. And then I think she's going to build it even more into Q1. So there's a ton of issuance, right, that they still plan on doling out. The question is it T-bill heavy or not? If it's T-bill heavy, then that's going to give a big boost to the markets. I think you will see a Santa rally. If it's not, and the composition is similar to what we were told it would be for the last couple of months, you guys can see how the market's performed, and that's going to be bearish. So on the surface, what we know so far as what she's said, it would be a headwind for the markets. But the key now is going to be on Thursday when they give us the nitty gritties about what type of issuance we're going to get, whether it's more T-bills or more coupons and notes, right? The longer duration stuff sucks all the wind out of this market. So that's what I'm looking at in the short term, Bob. Throw it back to you on longer term views.
And before you do that, can I burden you with one more question? Because you have some really interesting insight around Fed days. When the market sets a Fed price, isn't that a pivot that people look at to say, hey, we drove up to the prior Fed meeting, we drove back down through it. Do you have any additional insight for people on that? Or is that just a little bit too much for people to absorb?
I think you actually have more of a pivot effect around OPEX than you do the Fed meetings, to be honest with you. If you're going down, drilling down into OPEX or drilling up into OPEX, you oftentimes are going to put in a higher low around that and then bounce. For me, I don't know that I see that consistently enough around FOMC. Sometimes you get a continuation move through it. And that's why I don't really look at anything other than when we form that range, does it break up or does it break down? Because that has a much higher probability of telling you what the direction will be over the next week or two.
All right, cool. Yeah, it was just interesting to me because the Fed day, a lot of times check the day out the next day. Usually a lot of the trading opportunities happen Wednesday into Friday of Fed week. And usually what you see is not what you get the next day. So you got to be really nimble on those days if you're trading it. But Phil, I want to bring up this other chart, the CTA positioning chart, and the timing of this, especially with the gamma flows changing going into the rest of the year. These folks are massively positioned short, and they're not necessarily wrong money, but when they get to extremes, they definitely get barbecued. Mm-hmm. And I think we're in a situation now where it's extremely positioned short, just like the treasuries are extremely positioned short. And if you notice, they can't get the 10-year and 20-year down anymore. TLT has been resilient in this environment. I think we're going to see the same thing here with the markets. The markets are kind of confusing to people because the equal weighted market is down more than the SPY. So there's been a lot of technical damage already done in the market with a lot of stocks. And you may start to see people start to position into those positions because they might be down enough. And we may get a situation here that I think tied with the change in the flows with the options that could cause a bit of a rally here over the next couple weeks after we get through the digestion of next week. And like you said, Phil, a lot of it has to do with how much liquidity Janet Yellen wants to pull out of the stock market over the next 6 months. But we should get a pretty good sense for November and December here on Thursday. And I think that would determine for me how aggressive, long or short, I want to be going into Thanksgiving.
Yeah, I think I mean, if you look at the relative positioning to prior episodes down at these levels, and, I mean, we've been consistently down here all through since the highs, right, of 2022, beginning of 2022, I should say. We have spent a lot of time down here, which we normally don't in these markets. But if you look back at the bottom of COVID, even we're lower than that. And that was pretty severe. At the end of 2018, going into the start of 2019, again, was pretty severe. If you guys go back on that chart, that was a big drop at the end of 2018. It was pretty violent, a lot more violent than this stair stepping down that we're doing now, but we're even lower than that even. And those two areas were pretty sharp rallies from off those lows. Now, is the macro the same as those areas? No, it's different with different situation. However, you have to recognize the potential for a short squeeze. If you look at 2022, we did a series of where we got oversold and popped, oversold and popped. So I think, Bob, what we're going to get here is something similar where we're going to create that alligator tooth type zigzag where we're actually going to go lower than what we see here, but we're going to get these pops. So I think it's going to make for good counter trend rallies like we're seeing right now. But ultimately, I think the liquidity, we're still in a QT environment, right? We're still sucking liquidity out. Where's the market gone in the last 3 years? Nowhere. Since the start of 2022, we're down. We have lower highs and lower lows. Well, we have a big lower high. We're going to find out if we're going to get a lower low here where we take out last year's lows. But the point being is that I think we're starting to slowly see the effects where we're getting rallies, but they're dying because the amount of money was available to the system is much lower than it is now. And it's just a function of like the RRP being drawn down low. That's really kept us up, right? If the RRP wasn't doing its thing, if that RRP window of slush funds wasn't here, we'd be much lower. We'd be way below last year's low. And like we've pointed out before, the reverse repo money window is not always with us. That's something the Fed creates on the fly if they feel like the banks need stability. It's another form of training wheels for the market, but whether or not they keep it remains to be seen. I think because of the fragility of the banking system, regardless of what they say it's strong, it's not strong. They're going to keep the RRP around. So we're going to have that slush fund around for a little while longer. Otherwise, I think we would be in much lower levels on the S&P 500 than we are now. And so I think as long as QT is running, I think ultimately the Fed's going to keep sucking it out as long as they can to try to get this inflation down, which on the whole, I agree with. But I think once again, they're probably going to not manage this properly. And I think something's going to break and we're going to get one final swoosh down and they're going to throw in the towel. We're going to be right back at printing again.
Yeah, I agree. Remember, guys, no podcast tomorrow night. We're going to be open mic here at about 10 minutes for the Fed meeting. And we usually keep it going to at least till after Powell speaks, even up into the end of the day. So you're welcome to come on. You're welcome to ask questions via chat. And Phil will be on the mic and I'll be as supporting as necessary. So thanks for listening, Phil. Thanks for everything. And remember, hit like, hit subscribe. Today's the last day of the month. There's some specials laying out there. We've had an awesome couple of weeks here. The market is moving. Two-way markets are the best for traders. And we have the indicators to help you make money. And I don't know about Phil, but I went to cashier at the end of the day today, not look gift profit in the mouth and waiting for the Fed.
Yep. All right, guys, let us know your thoughts. How are you positioned? What do you think about the Fed meeting tomorrow? What do you think about Bob's theory here on the velocity of money? We'd love to hear from you. Post your comments below. Check out our stuff over at tradegenius.co, and we'll see you guys on the next episode. Take care.
Trade Genius.